Cool. All right. Welcome back. Start out, we'll talk about the market here. We're rallying today. Looks like based on the fact that Trump and Z had a phone call. We don't know what the call was about. Could have been, talking about their grandkids, but they had a phone call and market's up. Path of least resistance. We talked about this in the newsletter today. Seems to be up. All the doom and gloom doesn't seem to be happening. Things do look a little bit extended, but can't imagine we don't try to make a run at the all-time highs here. Um, from a thematic standpoint, I think it's kind of, trying to figure out what the meme of the day is. My thinking right now is you're going to see some money move into drone stocks. Started buying some of those yesterday. I was trying to sell some puts on Teledyne, but not liquid enough. It's probably not going to happen. And Kratos and AVAV are running away, trying to look for spots on those guys. So that's where it seems like we are. We got jobs tomorrow, so that could be a important number. Had some weakness in employment yesterday, which may give the Fed a little kick in the butt, but jobs numbers will be much more important. So, Jeremy, what are you seeing?
Yeah, bullish as ever, man. I think a couple weeks ago, we were comparing the data to the Doomers, and nothing really supported, a full market meltdown or crash or whatever you want to call it. We're still bullish. I mean, we're going into I like to call them measured moves, impulses that kind of step up, and we're in move number 3 right now, about ready to hit the halfway mark. I'm watching QQQ. I've got a liquidity target at like 533, and then if we can squeeze through that above 535, we got a shot at attacking that all-time high again. And as strong as the trend has been, it may just blast right through. I mean, there's a good chance we just come out of the top. We'll probably see some profit taking there, some accumulation, and then we'll see where we go from there. As long as things keep moving forward with balancing world trade and all that, I think we got a shot. And then the microeconomical stuff, you get into the weakening dollar, it almost kind of pushes a little bit more into being that other countries can start affording our export goods, and that's not going to be bad for anybody. So I can see some writing on the wall that things are starting to look good, and the themes. Well, we're going to love some of those themes.
Yep. All right, Pat, you want to go ahead and introduce our
All
guest?
right. First of all, this is the Circle IPO day, which I was last told was indicating up what would that be, like 29 at 50? No, up 19 at 50, maybe higher. I think it's going higher, but we'll see. Our guest is Josef Schuster from IPOX. He's here to talk about IPOs, et cetera, et cetera. So, Joseph, do you have a take on the market, man?
Thanks for having me, Ted. Yeah, you have to be bullish. I think if you want it or not, the rates are not able to derail the equity market. Even on the long end, we were at 5%. And what's been driving it, at least from our perspective, looking at IPOs and IPOX specifically, it's a huge performance of this vintage of IPOs 21, 22, 20, 23, 24. And those basically keeps the market up. We talk Palantir, GVM, Lenovo, all these spin-offs as well. And we always say if the IPOX doesn't come down, the market stays strong, and it is like that. And underneath is not a story of kind of bubble, but it's the earnings have been really, really good. So I think that's the underlying story. You have to be bullish. If you want to not, then especially going into expiration in 2 weeks' time, I think things are looking up.
So you're kind of fading in and out here a little bit with your speaker, right? You guys have that?
A little bit. It's
Trouble hearing, Joseph.
it's
Okay.
it stays peaked enough. I think it'll go out well.
Okay, all right. It just feels a little weird. Maybe it's on
Yeah.
my end. Okay, okay. So Joseph, all right. So let's just go cut right into it. You said in your most recent newsletter, the Schuster Watch by IPO, right, that SPACs are back, right? The index rose 12.25%. We want to talk about IPOs as well, but you have any thoughts on SPACs? Matt, you want to put up his webpage on the SPACs?
Do I?
Yeah, there, yep. There we go.
You seeing it?
Yep.
There we go.
And I don't mean to cut you off. I know you have a SPAC analyst, but I mean, well, let's just start there.
Yeah, I guess, like people saw it, investors saw it a few years ago, SPACs it's just like a one-time phenomenon, but they're coming back. The issuing activity is strong. I mean, we have hundreds of deals out there still, pending, and they keep on being at the same pace as the IPO market. I mean, that SPAC vehicle as such has become a great vehicle, great alternative, to bring companies public. And I think there are going to be a lot of exciting deals coming. Obviously, with SPACs, you have slightly or more risks than with IPOs. They trade also differently in the first, 1 year or so. But it has become like a venerable investment vehicle to take companies public. So it's definitely, a good space. And we have seen similar things in the SPAC world. What we see in IPOs is, if you want, the SPAC M&A market has been interesting. So there have been good deals, large companies picking up like these SPACs. We look at Chain Digital for MoneyLion. We look at Global Blue being taken over by Shift4, and I think that's also driving, I think, the attractiveness of the vehicle and the respective names as well. Yeah.
Go ahead, Matt.
No, I mean, no.
No. So it seems to me like it seems to me more like real companies are being put into SPACs. It doesn't seem as like, I hate to use the word real, that's the wrong word, but like less speculative, more mature, probably is a better term. It seems like more mature companies are going into SPACs these days.
Yeah,
Well,
we don't know yet. What was interesting in kind of the first SPAC boom, back in 21, 22, is, you had too many SPACs chasing too few deals, and you had a lot of questionable deals. But interesting, in a lot of those stocks. So we ran an ETF Sogu, back then, and in 2022, it was the top performing non-levered ETF in the country. It was inverse D-SPACs. So we had, I forget, 20 to 30, it was one or the other, D-SPAC names. And, and a SPAC, had a 10 floor. So, but once the merger happens, the floor goes away. And, all of these things were trading in like the ones and the twos. And everything was short sale restricted. So, I mean, this stuff was toxic waste. A lot of those companies have come back. A lot of the stocks that, we talk about, in the newsletter, or, you see people talking about in Discords and all that, are from those SPAC mergers, a couple of years back. And then you've also got, the companies that went under. You've got, hold on, we got a fire engine going by.
Always a good time. I get that once in a while.
Yeah, it happens.
I can inject something while we wait. Being in a pool of day traders and swing traders back then, it was unanimous. I mean, you just buy the rumor, sell the news, and it was kind of crummy to watch them all come right through that floor and just slam the bottom like a penny stock. But for the most part, traders were capitalizing on that anyway. They would just go buy the SPAC equity, run it up, and then cash in and move on to the next one. So it was really a saturated market for one, and two, it was just, I mean, like shooting fish in a barrel for a day trader. So is this the environment's going to change a little bit with that? I think maybe it's going to tighten up. That's kind of the things we're looking at.
I mean, what you've got now is you've had a couple of mergers announced, and and the SPACs have done well. I think most, if not all, and again, we've been talking about this Trump's inner circle theme. most, if not all of those are somehow related, like, CLBR, Columbia, merging with the gun company, who I can never remember the name of the gun company,
Right.
but Don Jr.'s on the board. Or, CEP, the Cantor SPAC merging with 21 Shares. That's Cantor, and that thing's Cantor's baby, and that's doing well. A couple
Right.
other Cantor SPACs that haven't announced a merger. You've got a couple of nuclear SPACs, and Trump just came out and and signed an executive order on nuclear. So I think it's too early to tell what this is going to look like.
Well, there was that Rocket Lab deal yesterday, right? That's and
What was that? I didn't see that.
wasn't it Rocket Lab they got bought at SPAC yesterday? Like
No,
it's
Rocket Lab's a public company.
Yeah, Rocket Lab's public.
No,
So-
iRocket. Excuse me.
That's it.
iRocket. My bad. iRocket was bought
Something
yesterday.
related.
Big deal. $400 million deal. They make like reusable space vehicles. We have a reusable space vehicle guy coming on in a couple weeks on the podcast, by the way. So that was a good one. So that's our space. So to me, it just seems like that company, instead of going public in an IPO, is going public via SPAC because it's a pretty mature company. I mean, in the sense,
Yeah,
So
I mean,
so let me ask you the question, Matt. Why would you go public in a SPAC versus an IPO? Or you too, Joseph? What's the difference between coming public in a SPAC and an IPO? And the pros and cons per se.
Obviously, I think if you're kind of a weaker company, much more speculative, I think it's better probably to do a SPAC. It's a whole structure which is different. The whole process to go to the market. In an IPO, you get new shareholders in, you do a regular book building, so the process is different. The levels of getting in is also kind of higher. The standards need to be higher. Usually, also kind of again like for more higher quality company in the short run. But again, like overall, I think if you look at the performance,
Yeah.
SPAC is more highly speculative. However, the long run distribution in those returns of the SPAC, they look almost like the IPO, almost as good as IPO. Like I look, because we buy specs as well for our ETFs, and we try to pick the good ones. And you look at we are holders of like Grindr. These are great companies. We used to have Symbotic, Hims and Hers. I mean, some of those names over time they just have developed as really good companies, as similar to some of the great spin-offs and IPOs which we have. So
did you just use the word distribution? Did you mean like who the owners of the deals are a good quality? It's like a good quality book. It's not just like junky owners per se.
I agree. Yeah.
Yeah.
All
right.
Yeah, and a couple other things, and I know they've been trying to change this rule, and I don't think they have. If someone comes public through a SPAC, they can make projections, and you can't make projections in an IPO, which is why what Joseph said, you get, the more speculative companies are going to want to go through a SPAC because they can, project out 5-10
Right.
years of why they're going to be making billions. Also, why those companies might do it is, if you've got a group operating the SPAC that knows what they're doing, they're going to be helping that company along as well. So you get, a whole management team and all of that. Really, at the end of the day, what you need is both markets working. You need a healthy IPO market. You need a healthy SPAC market. You need not too many SPACs coming out chasing too few deals. And that will end up, being ideal.
Another aspect is, I think, what's been good to see. I mean, some of the well-performing SPACs are also foreign deals. Like we look at, the casino deals out of London. We have, Super Group, Genius Sports, and for foreign companies who probably they want to go public, but they don't have a domestic market necessarily where they can go public. For those companies, maybe difficult to do an IPO, as well in the US. So they may, they
Oh
may
yeah.
more often than not, they choose the SPAC market. And again, like we have had tremendous deals. I mean, Super Group, Genius Sports, we had a takeover out of Europe, the Playa Hotels. They just got taken over, I believe, by Hilton or so. So the SPAC route has for these type of companies who have found it difficult to raise money in the domestic markets, but who want to do deals and who want to be going public. The SPAC structure has been really, really good, actually.
So do you have any, like you just mentioned a bunch of names, all right? So are any of these, you skipped it through, but like, are any of these are publicly listed US SPACs you're saying that are buying European companies, correct?
There's a European companies going public or as a D-SPAC here.
Yeah, yeah. Do you have any symbols or anything, Matt? Want to pull a couple of these up?
SGHC, that's Super Group.
SGHC, Supergroup. I like it already.
I remember that one.
Another one is GENI, which is Genius Sports. I mean, some really, really good deals. And
Wow.
Yeah, these are de-SPACs.
These are D-SPAC.
So what does D-SPAC mean versus SPAC? Is that something different?
Well, a D-SPAC basically is a consummated operating company. It has consummated the SPAC process and trades in the aftermarket, and that's kind of where the IPOX comes in to model these companies in with traditional IPOs, and we take positions on those companies in a kind of a long run for the first number of years.
Go ahead.
And we realize, some good European companies out of London, this GNI, I mean, that definitely made sense to carry over let it consummate, let it trade, and then get into these companies. We've been pretty successful in it. Same for some for US names, they're also in our ETFs here. So that's kind of how the predominant way how we look at the SPAC market, by creating this alternative to the kind of IPO. And again, like initially a few years ago, the sentiment was that's kind of a one-time wonder, all these companies, but some of them again they turn out to be big IPO stars or like de facto IPOs, and they're in the media all the time. Look at him and hers. I mean, these companies changing the whole way, like the Eli Lillys of the world are treated, because they're obviously also very interesting operating companies. So that's kind of how we look at SPACs at IPO.
Yeah, and a key point. So there's a big difference between a pre-merger SPAC and a de-SPAC. So pre-merger SPAC, blank check company, comes out somewhere around $10 a share. That money goes in cash. It sits in the bank, and they look for a deal. You can always get your $10 back, or whatever it is. It's in trust. Sometimes it's a little more than that. Once they find a deal, then they have to have a shareholder vote. If you say, hey, no, give me my money back, you get your money back. No harm, no foul. Once the deal is consummated and the ticker changes, you can no longer get your money back. That $10 floor goes out the window. So, we talk obviously a lot about asymmetry in the H.E.A.T formula and looking for asymmetrical trades. I love pre-merger SPACs because you always know what your floor is, and you've got the ability, your upside is virtually unlimited. So like you've got something like this one, which is an extreme. So you look, this is Cantor Equity Partners.
Yep.
Right.
So you see it trading right around 10 for months and months and months,
Right.
because that's what it's worth. It's money sitting in a bank looking for a deal. They announced the deal, and you see.
And who did they buy?
21 shares. They're doing. They're going to compete with MicroStrategy. So they're going to be a Bitcoin treasury company. Now, we don't own this, for example, in SPCX, because the risk is way too high. You've still got that $10 floor, but now it's at 43. So you could lose 33 bucks. So
Right.
that's a little extreme. This one is a little different. Here's Columbia. So
Right.
they announced a merger with a gun company.
Right.
Don Jr.'s on the board. Here my downside is $5, which is a lot
Right.
better than the downside being. And here's a new. Oh, I always get that one wrong. GS. Here's a nuclear one. For example, they announced a nuclear deal, and this ramp, this candle right here is when Trump signed an executive order on nuclear. Typically you don't want to buy that. Whoever bought it up at 11.17, that was not a good thing.
Chasing is a poor strategy. Good bank, poor strategy.
Yeah. Now, once the deal is consummated, then you're on your own. So, in our strategy for SPCX, we're out. Once that floor is gone, we're out. What Jeremy was talking about on the day traders, right around the deal, around the vote, around the symbol change, weird stuff happens. And there are opportunities to make and lose a ton of money. Be careful, but a lot of times what ends up happening is, you get a vote, a lot of people vote to redeem, there's not a lot of shares, and the retail guys can move this stuff.
So do you vote, Matt, and all that? I guess you must, right?
No, we're typically not good. We're typically going to sell. The problem for us as a fund is there's a little bit of a lag in getting our money back. So the only time we'd actually vote hey, give us our money back,
right,
would be if it's trading under trust. So, back when SPACs were dead, you might have a situation where, hey, if you get your money back, you get 10.05. And if I go to sell it in the open market, I get 10. So I may just say, you know what, I want that extra 5 cents. And we just wait for our money back.
Okay.
We're not going to be, once this stuff, de-SPACs, we're not going to be in that. And we don't run the inverse de-SPAC ETF anymore, which is a shame. I thought that was a great idea. But
And so I'm going to go from IPOX.com here. A pull-up symbol. This is one of Joseph's companies on his SPAC calendar, WTGUU. This is Wintergreen Acquisition. It's trading at like 10.02. There's a blank check to target telecommunication industry in Asia. Can you get that? UU, 2 U's.
No.
2 U's?
Won't come through.
No.
Oh, okay. Well, that's about 10. So he has a couple listed on here that are like in the 10s, just so you guys know, on IPOX.com.
I can pull it up on.
They all have like these weird symbols.
I can pull it up on Webull.
That's typically what they're going to do. They'll be around cash and trust.
Right.
In a perfect world, you want to buy them for under cash and trust. When SPACs get hot, you can't really do that. So, then what you do is you look at the management team, you look at their track record, you look at what their focus is, and, you're trying to pick SPACs that, run by guys or girls that, have some relevant experience. They're good operators that maybe done successful SPACs in the past, and it's industries that you want to get into. So SPACs have been a great way to play the Trump theme. You've got
Strike KOXX. Oh, wait. Go ahead.
Here's another Cantor one that's way over trust.
Try another one of his, KOXXU. This is a little bigger. That other one was small. That was like 50 mil. This is 200 mil. KOXXU. KOXXU. This is Coach Ave Defense. They're looking to buy defense and aerospace. You can't get that one either, huh?
No.
Oh, okay.
No.
All right. So let's move on. SPACs. All right. So let's talk about Joseph. Let's go back to you, man. So you have this thing called the IPOX 100 US Index. It's like the IPO. You say something along the lines of these are the new generation of companies. These are IPO companies or recently IPO companies, I guess, right? So, talk about that a little bit. And how do you choose those companies? And, not to be like negative, but why would you, let's say something like Circle, right? Trades today, it's going to open up, a ton. Would you buy that thing up, 100% or whatever?
I mean, we have restrictions, but I'm telling you a little bit about how our thinking. So,
Okay.
what Matt was saying is like pre-consummation, obviously that's one world for itself. So we really look at the de-SPAC world, and once these companies are being public, and once we can find out about the operating value and so forth. So we usually look at all the spectrum of companies like the IPOs, the SPACs, direct listings, the de-SPACs, the IPO M&As. So in this first 4+ years, when this going public effect really kicks in, right? That when you get the skew in the return distribution, you have a few Facebooks, but you have many, many Krispy Kreme donuts. So you have few companies go up a few 100%, but then the evidence is that the average investor actually loses money in the IPO. That's where we kind of started, many years ago. We said in mind to model that. So we basically technically, operationally, here we look at every company which goes public, like a SPAC, like a spin-off as well, like an IPO. We have an underlying universe. So Circle goes public today, it enters an underlying universe called the IPOX composite, right?
Right.
And then in this composite, it's a market cap weighted index. And in this composite, these companies stay around 4 years. So it's a rotational underlying universe, keeps all these companies in the first 4 years, market cap weighted. Right now, globally, 2,500 companies and so forth. And what we do then, like with our IPOX 100 index in the US, for example, if you want to pull up the ticker FPX, Frank Peter X-ray.
What is it?
Frank Peter X-ray, FPX, yeah. That's kind of our product.
No, not getting it.
You should have it on there. It's about $1 billion ETF.
FPX, Frank Paul X-ray?
Yeah, FPX.
Oh, T.
No, P.
Oh, P.
P is Paul. Fox.
Yeah.
First Trust IPO index.
Yeah. So it's a $1 billion ETF. If you look at the long run, it really looks good. It's in the market for 15 years. What we do is that with that fund is, we basically take the top 100 US domiciled companies which are in this underlying composite index. It's the best performing ones. We adjust for liquidity. We cap the largest names. So we take on a quarterly basis and make a separate index out of it. And that is actually a great way to get into, the good performing, large IPOs, the Facebooks of the world. The fund is actually ranked #1 out of 485 funds year to date. It's a good long run play as well. But that's kind of a semi-passive way to get into, de-SPACs, IPOs, and spin-offs as well. Always 100 names, kept at 10%, and is obviously a rotational strategy, right? We don't know how the portfolio is going to look like in 5 years' time, 4 years' time. But it's always kind of adaptive to what's coming. So we bought CoreWeave. That's already
right. Pull up CRWV, man.
Yeah.
That's been its butt kick today.
We added that on a fast track, like just a week after the IPO, that contributed like 60 bips to the fund.
Right.
And so we're going to see what we're going to do is with Circle. We have a provision in the index whereby we don't buy companies which pop like 100% or 200%.
Right. Can you ever get stuck on the deal price in your fund? I mean, can funds do that?
Funds can do that, yes.
Funds can do that. I think we could do that, but the fund is not set up to do that. It's a kind of an index fund. See, our kind of idea was, we are not interested in buying Google like at 35 and flipping at 42 or 50.
Right.
But we really want to get into 60 and carry it like through the first X number of years with 99 other companies. And again, like it's the fund and the underlying index is the IPOX 100. It shapes up as a kind of mid cap fund. Average market cap is 16 billion. Median market cap is 9. So also the CME has listed E-mini futures on it. So ticker is IPO M5 would be the CME E-mini future, which is tied to the IPOX 100. Isn't traded, but it's listed as an E-mini, so fully fungible. But that's kind of our world, how we look at IPOs, really
Right.
from an
So,
asset allocation perspective. So if you ask me who is buying that and who is it for, it's basically a key investor group is these financial advisors out there, like at Merrill or at the wirehouses, right? They get all these calls from clients, like today, how much CoreWeave should I buy, right? Or how much Krispy Kreme donut should I buy the next time, or SpaceX or so.
right.
For the financial advisor, he doesn't have the time, but he wants to sell something, and he
Right.
can sell very confidently something which is an index fund, which is really an asset allocation into that space over the long run. And obviously, we wouldn't have been where we are. That's a $1 billion ETF now if it didn't work, like from a performance perspective. But it has really interesting kind of performance dynamics. As I mentioned earlier, it's a great way to get into this, if you want, this new generation of companies before you actually know it.
Right.
Because we
So,
assume that obviously IPO activity is always something forward-looking, right? And it gives you an indication of where things are going. And I think like what's driving it this year, like like we are still long Palantir, we are long Samsara, we are long CG, we are long Reader Coco, we are long Grinders, a SPAC, and all these things, and it's developing as a very interesting indicator of these newly listed, this next generation of companies as a diversified trade away from the S&P or away from the
right.
MSCI, which have all these companies in there which are totally aging, right? The Microsofts, the Googles, the Teslas. Now they're not going to exit the S&P, so they're kind of aging out there, and then we'll see. Hopefully they go up, but more often than not, they probably won't go up that much anymore. So the IPOX is kind of a good way kind of to capture these new, these new kind of companies. Obviously, we don't get into the syndicate or even the pre-IPO space because it's a 60-bit fund. It's cheap and cheerful, kind of applying like indexing to that space. And that's how we have made a business out of it. Around $2 billion tied to the IPOX 100 in terms of AUMs, and we have a whole global index series. So for Nordic, for Europe, for international, China has done really well as well. The Chinese, the IPOX China doubles the KWEB, year to date. It's a great play into this next generation of companies in a positive way. So we don't really go short, but that's kind of our world. What we do here in Chicago with the team, and we have an office. We have an office in Edinburgh as well. And obviously, SPACs that play what we see from the data. They play an increasingly important role. As Matt's world of the actual SPAC, but we see these many de-SPACs. They actually are turning to be really interesting companies to consider. And I was, mentioning a few earlier. I can mention a few in addition.
Please.
MP Materials. That's Josh. Josh mentions that on CNBC all the time. They are long. MP Materials. I mean, in the long run, that has been a great praise. Oklo. ASD.
Oklo. We know that one, right?
Oh yeah.
The most
I know that one.
Respect, great trader, and like you take a shot on again, like on a new era of how we obviously almost like a competing company to SpaceX, a great kind of way to play SpaceX. with a public company. You can play with the
Which
spec
one?
of AST space mobile, right? You can
What
play
symbol?
ASTS,
Yes.
ASP.
ASTS,
ASPS.
ASTS.
Apple, Sam, Tom, X-ray.
S is sugar, and Apple, sugar, Tom, sugar.
Oh, ASTS.
Yeah.
Yeah, just give
Yeah.
me a second. I gotta short some Tesla.
Oh, you get. I knew it. I knew it. I knew it was coming. So Joseph, as long as we're segueing here, you live in Chicago, right?
Yeah,
So do you like the Italian beef sandwiches? What's your favorite one? Bueno?
I'm not into the Italian beef.
Oh, you're not.
So,
How about the deep dish? No?
well, I'm a New York pizza guy, so I really
Oh,
like
okay.
it.
There you go. I love New York pizza too, man.
I came here from Germany 15 years ago. But yeah. Anyway,
I like
but
literally
I'm a New York pizza
I was
guy.
in New York
Everybody
I was in New York like a few months ago.
Yeah.
Went to this place called Carnegie Pizza right behind Carnegie Hall. I swear it was like the best pizza I've ever had, dude. It was like
Best
insane.
pizza.
I was like heaven. I couldn't believe it, bro. Couldn't
Yeah.
believe it.
Yeah. Anyway, like going back, so it's Apple, Sugar, Tom Sugar, ASTS.
Yeah, okay.
Yeah.
Interesting company.
Hold
Trades
on,
like
we'll give him a
2
sec
years
here.
now. I mean, that's one from 2021. I mean, what I want to say, and I think that's obviously your business is a SPAC, and I think a lot of these companies, there's a reason why they choose that structure, and there's obviously losers, many losers, but I think also really interesting winners. I mean, coming out of these SPAC dynamics, and then they trade differently than an IPO was the first year, because the whole shareholder is very different. But some of those, I mean, we look at them, and I mean, we think they're like as good as the IPOs nowadays, coming out.
No. Yeah, that's what I was saying too. That's what I was saying too. I mean, why go through the headache of an IPO if you can do a SPAC? And I mean, yeah, it pops up 50, but you don't see that money anyway. So, like, what's the point, really? I get the point,
Yeah, it's always the IPO still has the advantage, like the circles, they do well, or like even core.
Yeah, I mean, it has a book, it's institutional, all that, but yeah.
Assuming they do well, they give you tremendous marketing benefits, right? The well-performing IPO gets you in the media everywhere. You don't hear much about Venture Global nowadays.
Right.
It's then public, which was such a crazy, terrible deal.
Right.
It's halved in the first few months, so you don't hear much about that. But you want to structure your IPO to be attractive.
Yeah, it's better marketing.
You get a lot of marketing benefits down the road.
Yeah.
You leave some money on the table, but then you get your CNBC exposure and all the exposure in the other.
Yeah, exactly.
So it's something going for it still. But for those companies who don't want to do it, or say would be more mature industrial kind of types or basic materials or so, the SPAC structure is great. And again, like I think another area which really plays for it is, the statistic is that around 30% of all the IPOs/SPACs in the first 5-6 years are being acquired, right?
Right.
So it's this whole universe of companies which we trade on, like the IPOX and your universe. I mean, that's a target market for corporate M&A. And
I got a question for you, Matt. Are you with us now?
I am. I just had to short some Tesla.
All right. So to me, this is like an edge. Is this an edge? So we have the heat, Joseph, we have this thing called the heat formula. It's not an edge.
No,
this is.
Okay. IPOs aren't an edge. You don't think if you can get out? No? Okay.
The only way IPOs are an edge if you can get in pre-IPO.
Right.
But Joseph disagrees, right?
I disagree.
Right.
No, that's fine.
I got it. Okay.
So I might have a little injection. When it comes to stuff that's going pre-IPO, if you've got a good enough SPAC company that's got a good track record of finding the right ones, and they tend to focus, just look at basic market structure. It's like getting ahead of the first part of market structure. Everything just hypes up climbs exponentially and, runs away. And that's long term. It takes several months for it to get there. And then it all gets capitalized down. And eventually you get the lagging consolidation that goes flat forever. So if you even like zoom out on Oklo down to the monthly chart, you'll see it. It's basically when that was a pre-IPO. If you would have got in there, you got that nice flat long range there. You get some capitalization once the lockup is over and that pullback, and then bam, it just runs like a rabid dog up to the top of the hill, man. It can be a benefit. I don't know if you can call it an edge. I don't know if you can call it asymmetric, but I mean it's still a damn good trade if you do it right. Just my opinion on it.
So pull up the SPCX chart, Matt.
Oh, that's
So what are we thinking? What are we thinking here?
Hold on, daily.
So if you're trying to get into that, is now the time, you think?
Probably shouldn't comment because it's our own fund.
Oh, I see. Bad combo. Okay. All right. So let's move on. All right. So I'm going to talk about like the future IPO calendar. You discuss that. So let's say I am an investor. So let's say I'm an investor and I want to get some research on upcoming IPOs, Joseph, right? So I go to your website and I pull up the calendar and, I'm going to look at the different names. So I have like one in front of me, like ASIC, symbol ASIC, Integrity Specialty Holdings. It's an insurance company. It's a big deal. I'm sure it's coming from a decent underwriter. What do you? It's not public yet, Matt. So it's an IPO.
Yeah.
So do you like make calls? Like you say, oh, Pat, I think that's going to open up 6 or 4%. Do you do stuff like that? You just talk about the fundamentals. Kind of give me an idea of what you do because I'm an old IPO guy, way back.
So we are totally agnostic. All we need is deal flow to keep our portfolio alive, this portfolio running, right?
Right.
So we look at, so generally we are agnostic, but we look at the deal characteristics closely from the SEC filing. So what we look at, I think what's important is how much the company brings public, right? The float, the number of shares issued over the total number of shares outstanding. I think what we generally want to see is between 15 and 30%, right? If it's too little, they're going to move the company up because they don't need it to sell a lot.
So wait. You're saying if they have to be selling at least 15 to 30% of the company for you to look at it, right?
Yeah, we look at all of them, but I think to make it a good judgment in terms of, to see, get a good sense of where it's going to trade, I think that's what we want to see.
Right.
Obviously, we want to look at, the size. It needs to be, $1 billion up for sure, like $500 million. And then we look at once it opens, how it basically opens. If it opens too high like this, we don't like these companies which have initial returns, these initial profits like 70% upwards, because you can show that those over the long run are can be big drag in the portfolio as well. And companies would actually open low as well. Like, if companies open negative, that's not a good thing either. So you want to see kind of the optimal IPO in terms of the technicalities. We have this type of, that's what we look at. We look at fundamentals, obviously, from a sales, the revenue multiple perspective as well. And again, like the insurance company you mentioned, definitely something I think we are going to look at. Insurance has been hot, has been a good market to be in. And they have been always kind of providing interesting diversification benefits as well. We are long CoreWeave. That's probably something you want to have against it. And when CoreWeave goes down, that's probably not going to go down as much. And so obviously, what's most important? Yeah.
All right, next question. So I'm just going down the list here. I went to the NASDAQ IPO. So there's another company, it's a small company. I don't even want to mention the name, but when I look at it, I say, oh, these guys are really small. They kind of have I wouldn't call just a small underwriter, for lack of a better word. So do you do anything with underwriters? You go like, oh, I'm never going to buy anything those guys bring out, or these guys are great. Do you make any choices like that?
So for our IPOX 100 funds from FPX, for example, we have obviously we look at the largest deals in the universe. So market cap is basically driving the decision, to buy or not to buy. So
there's a minimum market cap?
there's no
Um,
minimum market cap, but the thing is, because we pool spin-offs, IPOs, SPACs together with the spin-offs, we get a median average market cap of like 9 billion, average is 15 or 16 billion. So we don't necessarily look at these micro cap funds for micro cap companies for this particular funds
got
in
it.
IPOX 100. However, we do manage a product for a Japanese client in Tokyo, Rakuten, and we for that fund we subadvise that fund, and for that fund we look at micro cap and small cap IPOs as well. But
Got it.
that's not a US product; it's a foreign product. For the predominantly US index-based ETF, we look at just large ones, and
Got it. Okay.
it's been working. Yeah.
So a circle opened yet, anybody? Does anyone have that? Is it trading yet?
Not yet.
Any indications?
It doesn't say when it's going to open on my
65.
broker.
Yeah,
65.
65 to 67.
Oh.
Who called it? I called it.
Yeah, that
What'd
jumped.
I say? I said it. All right. So
You should
the
be an
next-
analyst.
I am. All right. So the next one is Chime Financial, right? That's coming out soon. Obviously, Chime will be a fintech company, checkbooks, all that. Any thoughts on that, or kind of same type of stuff?
Yeah, came off a lot from its pre-IPO market kind of valuation. It's kind of less insane valuation. But here, again, like you want to hold it with some kind of weighting, I think low weighting with 99 other companies. That's how we look at it. Yeah, that's what I can say. It's a growth market, but it seems to be, more mature than it should be. So it should have gone public a while ago.
Yeah, I like this one, by the way. So how about Voyager Tech? This is space tech, 400 million IPO in this New York. I love this one. We love space at our company, so this is another one. Yeah?
Yeah, I think it's gonna enter our universe for sure. Not sure if it's gonna enter the IPOX 100, but I think you want to buy these companies on the first day and hold it for see how it, see you want to buy some allocations and see how it trades, and then see where it goes from the earning. You'll see how the first set of earnings are coming out, and sometimes they can go up much more. Sometimes in biotech land, for example, they can drop a lot. So I think you wanna definitely consider the space companies. There's just a lot of hot money just chasing those deals. So.
All right, last one. Omada Health. This is virtual healthcare, basically. This one, I'm a little thematically, I don't quite follow. So, what do you think? This is good or bad? It's probably good, right? But what are your thoughts?
Again, like we have to see the pricing. So
Right.
I think the risk from all this vintage of IPOs coming now over the next month or two, they're gonna be more expensive than they should be initially, I think, and it's all because CoreWeave has done so well, and our FPX, the fund is up like 18% year to date. Huge alpha in IPOs nowadays. This vintage of 21, 22, 23. So this alpha basically plays out into how expensive all these companies are, which are going to go public from now on, because it's kind of a follow through. So you got to be careful in terms of rating, but still you wanna probably try to get a piece of it one way or another, but not too much.
Right. Okay. Last set of questions here. So we also talk about the private market here some, like, Anduril, SpaceX, Figure AI. Like, that's where there's a lot of money being made. There's actually like a secondary market in those. Do you have any comments on that market or those names, or like how does that market develop? And, it seems like that was the IPO market, or is kind of the de facto IPO market these days. I mean, you get liquidity there. It's a big combo, but any, kind of last minute thoughts on that?
Yeah, it's interesting how the pre-IPO markets have emerged. There's, one thing which bothers me, it's extremely expensive to participate, there's only obviously upside, I don't see any pre-IPO index whichever has gone down huge. It's all kind of, there's always a bit to the upside.
Right.
The fact is, I think for the really smart investors, that's how we look at it, who has 10, 20 billion to invest. The way to invest in the pre-IPO market is through the post-IPO market. Because the characteristics of post-IPOs from the beta, from the age and so forth, is very much similar to the pre-IPO market. Yet you can get out anytime, you can get, there's plenty of liquidity. And, look at FPX versus, the Morningstar PitchBook index. It's the same year to date, up 18%. Pre-IPO is 18%. And however you have no gates, you don't pay 5 and 20 or 5 and 50. You can deploy 10 billion if you want. And I think that's a smart way to play it. However, obviously for the private investor who wants to have sexy hot deals, pre-IPO may be something for them. What we observe is obviously that the risk of default, I think, is shifting to pre-IPO nowadays as well. So it's actually
the risk of default, you said?
Yeah, I mean the risk of bankruptcy and so forth. I mean, there's the default risk used to be in the post-IPO space, right? When companies go public because there are so many of them.
Right.
But now it's with the rise of the pre-IPO market, because companies don't necessarily need to go public. Those risk of the default is actually shifted to the pre-IPO market, and that's something interesting to observe as well. But again, like that's my comment on it. But it's a market which is fascinating, I think, which everybody should not ignore. But I guess like there are various interesting ways to play it. And one way, obviously, in our opinion, the smart way, for investors is to play post-IPO rather than doing all the paperwork and pay this huge broker commission just to get a few shares of something.
All right, Matt, I got a question for you. Last question, guys. So, Matt, so we talk about Anduril in our company quite a bit, which is Palmer Luckey's defense company. We talk about SpaceX some, I think. Obviously, everyone knows what that is. We talk about Figure AI, robotics company, all big, 200, 400 billion, whatever companies. All right, that's 400. That's probably too much. Let's say over 10 billion companies. So is there any way to put those into an ETF? Obviously, it kind of the name private company means no, but couldn't that work in some way?
You can have up to 15%. But
that's it.
But it becomes problematic, because if you put 15% in and you have redemptions, you go over that limit. And if it's a private, it's not easy to get under that limit. If you have a whole bunch of money come in, you may not be able to put it to work. So I think one of the potential uses maybe of tokenization,
that's what I was about to say,
is right, being able to use that in some way, shape, or form to access the private markets. But right now it's problematic. There is an ETF that I think has like 10% privates in it. I think it's mostly in SpaceX, but that's, the best they can do.
Right. Got it. All right. So, Jeremy, you always have something to say. Anything else, bro? You got something up your sleeves, or we can call it here if you want. Or Joseph, anything?
Yeah, I think Matt addressed a great point, I think, about how to get into these companies. And we have only been in a bull market in the private markets in the last 1 to 2 years. And if the bull market in SpaceX doesn't continue, and this company should halve or whatever, things can happen. I think there's a chance of a rude awakening by buying those ETFs as well. So things don't go up all the time.
Right. Okay.
I kind of take there's a comment you made earlier about doing a post IPO thing, and that, as a trader, that's kind of where I sit. I prefer to kind of wait things out, because I'm pretty keen on identifying that typically something IPOs, it'll have that hype wave, and then I call it the halving, because you'll have the IPO price. It'll give about half below that IPO price and then come back through that. Once that trend begins, that's where I kind of come in and go long. I did that with Uber back in the day, and bought it at around $20, sold it at 54, kind of the same deal. If that's the case, is there a way to navigate that with a SPAC where some of the is there a way to reserve some funds to get in after the IPO and then finish taking on more weight in whatever company you're bringing public?
Oh, I see. So Jay has a question, I think. Is that a question?
That's more of a question, yeah.
I think the question is, Joseph, let's say, can a SPAC, what would be the way? Can there be, I guess this would be a D-SPAC. Can you have a D-SPAC and own less 100% of the company? So could you have a D-SPAC and only own 50% and then be able to kind of come in after and buy more stock? Because Jay says the stock's going to be cheaper after the deal.
I've never heard of that.
That's what you said, though, right, Jay? Yeah,
that's kind of what I was wondering. So if you can go in, like you were saying, post IPOs is where most of the traders and investors are going to tend to watch. They want to make sure the company's going to be at least somewhat successful in the beginning after going public. Valuations aside, so if a SPAC were to come in and say, yeah, take it public. That was the question: do they have to be 100% in, or can they be, a lower percentage and then come back on the after IPO? And that answered itself. So,
all right.
What I can say is here, so we have a SPAC index which actually does set the SPAC on Bloomberg, the SPAC IPOX SPAC index. It takes 30% in SPACs and then 70% in D-SPACs right now. So it has a kind of a dynamic allocation between those two.
Yeah, we're big fans of just pre-merger.
Right.
After that, it becomes more of a trading thing, and then it's not asymmetrical anymore.
I'm a trader.
So Matt,
what can I say?
Last question. So what happens if this slows down? Then what? Then it just then it slows down and it's dead, or what's the next? What would be the next move? Yeah.
Then you just go back to trying to find, SPACs with $10 in trust trading for $9.90.
Nope.
Right. Got it.
That one that was mentioned earlier was trading at like 10.02. I looked at it, and you weren't able to pull it up on stock charts.
Got a different amount in trust.
Yeah, of course.
So you could be trading at 10.02 and have 10.15 in trust. In which case, we're going to buy it at 10.02 and it's worth 10.15.
Right.
Right. Got it. All right.
So not sexy, but you're consistently hitting singles.
If you're getting your own alpha, doesn't matter.
Right. Got it. All right. So IPOX.com, just where you find Joseph, Matt, me. We're all Tuttle Cap. Anybody have anything else?
I think that's it. I just got to make sure.
I got to go short some more Tesla.
Yeah.
All right, guys.
I'm going to make sure I put a link to IPOX in the description later on. I'll make sure it happen.
Cool. All right. Thank you, sir. Thank you, guys.
See ya.
Thank you for having me.